This week on Bullshift, the podcast, we talk about the concept of advisors alpha. Do advisors add value? If they do, can we quantify how much that is? What exactly do you think financial advisors can do to add value for the clients they serve? Welcome to Bullshift, the podcast. This is the podcast that talks about how the financial services industry shifts your attention to make you feel more bullish. My name is John DeGuy. I'm the author of the book Bullshift and the host of the podcast. My guest this week is Colleen Jaconetti. She is a senior manager with the Investment Advisory Center at Vanguard in the United States. She's had more than 25 years of experience in the financial services industry. She has an MBA from Lehigh University, and she's also a CFP and a CPA. Colleen, welcome.
Thank you. I'm so happy to be here.
I'd always like to begin by having my guests explain a little bit more about the work they do, because they come from disparate backgrounds and have various areas of expertise. And yours is particularly useful because it's the interplay between advice and advisors and the role they play in helping investors meet their goals. So maybe tell us a little bit more about the Investment Advisory Center.
Sure. I mean, I would have to say, I think I have the best job in the world. I've spent really the last 25 years at Vanguard developing thought leadership and research around how advisors add value, how they can quantify that value, and how they can articulate that value to their clients. So from my perspective, I couldn't ask for a more rewarding job. I've spent time in our investment management division, our retail division, our institutional division, and now we're in our financial advisor services division. And the mission of our job, and actually the mission of Vanguard, right, is to take a stand for all investors, is to treat them fairly and to give them the best chance for investment success. So to achieve this mission, given the majority of assets are advised, like Vanguard and our group in particular, right, we engage with advisors. So we engage with the advisory community and we support them in the research that I had just described. So right, how do they develop and deliver a value proposition that's based on best-in-class investments, wealth management, and behavioral coaching. And we refer to this holistically as advisors alpha. This is the alpha that advisors create for their clients.
So that brings me right to my next question, which is perhaps you could explain in a little more detail what you mean when you refer to the phrase advisors alpha. It's a phrase that most people have not heard. I hadn't heard it until I came across the research, and I've been aware of it for maybe a half dozen years or more. But when you talk advisors alpha, what exactly are you referring to?
Yeah, so we actually started Advisors Alpha in 2001, surprisingly. And it was initially just a concept of saying, we would like advisors to consider the value proposition that they provide to extend beyond investments. So definitely not saying that investments is not important, but that also there's value to be provided from relationship-oriented services, right? Comprehensive financial planning and behavioral coaching. In 2011, we actually put out our first paper on it. So it took a little while to have the concept cook up. And the paper basically encourages advisors to redefine their value proposition, right? From trying to outperform the market through security selection, and instead spend their time focusing on financial planning and behavioral coaching, where we really believe advisors can add significant and more predictable and reliable value. Then in 2014, I would say the biggest follow-up from the 2011 paper was, well, how much value, right? So everybody was dying to know how much, right? So in 2014, we put a number on it, right? So we quantified that the value of working with an advisor, right? And this is an important piece of who is following wealth management best practices is about 3%. And what the 3% is the hidden drag or unintended costs that results from following, from investors not following the wealth management best practices. So it's saying, if you would have gotten a 10% return in the market, many people would have maybe only netted 7%. And we're saying by working with an advisor, and that's due to different costs or unintended performance drag, right? Working with an advisor, you can keep closer to say 9% or 9.5%, right? So working with an advisor who's following these wealth management best practices helps you to keep more of the returns that you earn.
Okay.
Yeah.
Okay, so I'm going to come back to this because I know the critics will say, well, it's difficult to quantify the counterfactual in terms of knowing what the person would have done work with an advisor, because what you have is you have two different disparate things. But before we get into that, I'm wondering if you could take a moment to walk us through the landscape by talking about current industry trends, because I want to go from the general to the specific. So before we dig too deep into the advisor's alpha comments, maybe you can offer some thoughts about what you've been seeing in the past, I don't know, 3, 4, 5 years in the advisory services industry.
Yes, I mean, we continue to see an acceleration towards fee-based advisory models, right? So big shift, especially, in the US from commission-based to fee-based, and that has continued to accelerate. Also seeing, a rapid diffusion of technology, right? So as more technology comes out, right, there are a lot of new entrants, right? So there's, robo-advisors and the like. So new entrants into the advisory space who can operate at a much lower cost, right? It's also much lower touch. And then increased emphasis on transparency. What value am I getting for what I'm paying? And doing what's in client's best interest. So I would say all of these things have led to an increase in competition within the advisory business. And that is really why we believe that, it's never been more important for advisors to have a really strong value proposition and not only provide that value, but actually be able to articulate that value to their clients, which is, has been difficult at times.
So here's where you and I, even though we agree, I'm going to guess on about 90% of things, there will always be a few things where even friends will respectfully disagree. So I believe advice adds value. I'm a bit skeptical of the 3% number, but one of the concerns that I have, and one of the purposes for this podcast is when I talk about bullshift, is that part of the behavioral coaching that advisors do is they shift people to take a long-term perspective, which is overwhelmingly positive in most instances, depending on how things go. The concern I have is optimism bias. The concern I have that other people are not always as willing to recognize is that advisors will maybe talk about a better tomorrow without drawing enough attention to the risk people are taking in order to get to that better tomorrow. And then, of course, we have the problem of prospect theory. When you say, well, the pain of a loss is felt twice as acutely as the joy of a gain. So if you're trying to take people from A to B and you want to be the shepherd and the person helping them along, the concern that I have is that if you make it sound too rosy and the path is not as free of obstacles as you might have previously did, it'll actually do more harm than good, because it'll make it more difficult for the people that you're trying to follow along on the path to actually follow you, because they're expecting things to be easier than they really are. I said a lot there. I'm going to comment in general.
Yeah, I mean, I perfectly agree with everything you're saying, right? And the truth is, the most important thing an advisor can do is get their clients in the right asset allocation, right? The asset allocation that they can stick with in both the best and worst of markets, right? So if you're trying to take a client who should be, in a 50% stock, 50% bond portfolio to a 70% stock, 30% bond portfolio, that shouldn't be there, right? Because their risk tolerance wouldn't warrant it, right? Then that's just really not what we would ever advocate for, right? The point is, first and most important thing is get the asset allocation right. The rest of it doesn't really matter if you're not in the right asset allocation, right? And so kind of how I think about it, even in my own life, is how much money am I willing to lose? And then I look at how much stocks return. And when I see, so I would say, based on my age and different things in my life, like a few years back, I kind of looked at my portfolio and I'm like, wow, if I lost X amount of dollars, that's going to really hurt. I'm either going to be working longer or my kids aren't going to colleges or things like that. So I actually went from my 100% equity from my youth and pared it back. So I think there has to be a recognition that losses is the thing that really makes people not be able to sleep at night. And you shouldn't have an allocation of equity that exceeds the amount of money that you're willing or comfortable losing. Right. And then for advisors, it's really not good business at all to be considering putting people in asset allocations that are more aggressive than they should be in, because at the end of the day, they're probably going to terminate the relationship with the advisor. So the advisory business has huge upfront costs. If you don't at least retain the client for 3 to 5 years and you're trying to move them in a spot where they didn't like it and it didn't work out well, right? None of that is good for the advisor. So I guess it starts out everyone's best interest that you have your clients in the right asset allocation from the start.
Do you think, I'm going to ask you this question in 2 parts. Do you think advisors do a truly good job of getting a good handle on how much risk their clients can take And the second part is, do you think clients themselves have a truly good handle on how much risk they can take? So when you say, how much money can you lose? You don't know in advance how much a market's going to drop, and therefore you can't reliably in advance set an asset allocation that will map to a potential loss. Do you think people generally do a good job, or do you think we could do a better job? If we can do a better job, how would you do it?
So I don't know that I could speak for advisors as a whole, but I would say generally speaking, I think people have a good awareness of, for each equity allocation, say in 10% increments, what is the maximum gain over the history, say since 1926, and what is the maximum loss. So personally, what I would look at my portfolio, I'm just making up these numbers, but say if I have $2 million and the maximum downside on I'll just say 100% equity portfolio, say was 40%. And I'm 100% equity, and I'm looking at my portfolio saying, if I lost $800,000, I would have a nervous breakdown, right? Or I would be really upset, right? And then you say, okay, well, let's pare it back. Is a 80% allocation to equity giving me a level of loss that I could sleep at night, right? So I think we just have to, the best we could do is use history as a guide, and then be honest with yourself of can you stick with this allocation? So I knew if I had an allocation such as where I lost 40% of the portfolio, I would not be able to stick with that, right? Not that I couldn't stick with it. I would know that fundamentally I should stick with it, but it would make me really unhappy, right? So I think that's probably the best way for people to think about it, is just how much are you willing to lose? Because the upside is not going to be as rewarding as much as the downside hurts, as you mentioned in the opening.
The research that you've done, well, not you necessarily personally, but the good people at Vanguard over the past 20 years or so with regard to the concept of advisors alpha, was fairly accurately to the research by another group called Dalbar. They every year put out a paper, which they update annually, called the Quantitative Analysis of Investor Behavior. And I've asked them, and they've acknowledged that this investor behavior that they're talking about is oftentimes the investor of people who are working with an advisor. So my joke is it might be a quantitative analysis of advisor behavior. And this is where I'm interested, because you're absolutely right. The Dalbar number also puts the delta at somewhere around 2 or 3 or 4% in terms of how well the market does and how well the investor does in comparison, because the market does what it does and has its variance, but investors are supposed to buy low and sell high, but they very frequently, especially absent proper behavioral coaching, buy high and sell low. And so it's interesting that we have a lot of that. I'm wondering, what have you done at Vanguard to disaggregate the performance from people who are just do-it-yourselfers, from people who are advised, people who work with an advisor, to get to your number?
So actually, that's not really what we do. So we haven't segregated if you work with an advisor or not. The about 3% is compared to is basically an average investor, and if you were following both management best practices or you were not. So it's say if someone rebalanced or they did not. If someone implemented the lowest cost quartile of investment funds or not, as opposed to looking at a population of people who we know did not rebalance versus a population of people that we did not know. So in our, I guess the about 3% is theoretical, right? And it's trying to say at a high level, rebalancing adds a certain amount of value. And we always say it could be zero, and we try to give the high end. So we just try to provide, this is the range of value that we think advisors can create. It could be more, it could be less. So like an example would be if you're spending down from a retirement portfolio, so you have taxable, tax-deferred, and tax-free assets, some mix, right? We say, if you follow a certain order, this is the value that could be created relative to, not following that order. So it's definitely not a live study of investor A versus investor B, and one works as an advisor and one does not.
Okay, but it is an attempt to quantify factor A, factor B, factor C, factor D, and then if you add them all up and they all have a range, then the sum presumptively is somewhere between the lowest of the all added up and the highest of the highs all added up, and that gets you into the range of, it could be lower than, it could be higher than, but something in the 3% order of magnitude. Of those factors, my are the most important is behavioral coaching, and it makes up about 1.5%. I'm wondering if you could talk about what you believe the most favorable aspects of behavioral coaching are, and maybe walk the listeners to what that entails.
Yeah, happy to. So, I mean, I think the most important thing, and it's kind of what we're touching on, is that investing evokes emotion, right? People's money is very personal, right? So advisors can help their clients maintain a long-term perspective, and really help them to not do things that could harm themselves. So as you were saying, buying high and selling low, right? So I think the most important thing that advisors will do is helping investors stick to these time-tested principles. Like, everyone knows you shouldn't abandon the market, or everyone knows, right? Rebalancing is a great way to manage risk. Obviously we had higher returns if you don't rebalance, but the risk could be exceeding what you would want. The hardest part is sticking to them in the best and worst of times, right? So the hardest part is, if the market's doing very well, the equities are having a really great performance, some people hesitate to want to rebalance. But what could happen is, if the equity markets have a pullback in the future, you would have a bigger loss, right? So it's just helping people realize, okay, if we agree to a rebalancing strategy, this is what could happen if you don't follow the strategy, right? And we decide to let the equity portfolio continue to run, and now you went from your 50% equity portfolio to 80%, and are you comfortable with that, right? Or when the markets are going down, right? People have a tendency to say, oh no, this is horrible, I need to get out, right? And what they don't realize is sometimes that could be the worst thing that they could do, right, is getting out.
So one of the things I'm curious about, I don't know if you've done the research, but I'm curious if you have, and if you haven't, if you would consider it. You don't really disaggregate between people who are working with advisors who are not, which is why the critics will say, well, then how do you know this can be attributed to the advice? Because you're commingling those working with advisors and those without. But if you were to try to do the research to disaggregate, I'm especially interested if you could find a way to disaggregate those working with a traditional advisor, where you have to call and say, Mr. Jones, I'd like you to rebalance. As you know, we have a 60-40 portfolio. Stocks have been doing well. You're closer to 70-30. I'm going to ask you to take 10% off your equity portfolio and put it in income. And Mr. Jones may or may not agree, as compared to someone who works as a portfolio manager, who has a fiduciary obligation to do what's best for the client, and who can use discretion without calling the client to get sign-off to simply sell the 10% of the equity that's up and use the proceeds to buy the 10% of income that's currently down, relatively speaking. Has that kind of research been done? And if not, are you contemplating doing it in the future?
So we have not done that level of research. When we provide that about 3%, we're using aggregate industry allocations. And why we think it's applicable to advisors is because the majority of invested assets are advised, right? So that's why we're comfortable with that. The other part is it's difficult to get that information. So advisors would have to document that, and then they'd have to be willing to share that with us. So it's just not that we wouldn't be interested in or hadn't thought about trying to do that type of research. It's just the data is not available. Right. It would require a lot of documentation by advisors, and then also willingness to share that type of information outside of their practice.
Okay. Now, I'm wondering if you could also walk us through some of the other factors. We talked about behavioral coaching being the big kahuna. It's the first among equals, but there are other factors. Looking at your research here, I'm seeing cost-effective implementation, rebalancing, asset location as opposed to asset allocation, spending strategy, which is where do you take the money from, which account, the registered or the non-registered account, and retirement drawdown. Maybe can you walk us through those other factors and the extent to which they come into play?
Yeah, I mean, I would say with costs, right? What we did there is, obviously cost is going to be relative to value. So by no means are we saying only select the lowest cost investments, right? Is cost relative to value. So I don't want to, say that. But what we did was we said, if investors, right, because cost really comes down to, math, right? Gross returns minus cost is net returns. Net returns is what you can eat or take home and spend, right? So really, when we looked at it, we looked at what is the lowest 7% of funds. So what is the lowest cost quartile there? And what is the median or average? So when we looked at the median, the value add here, we said was like 30 basis points there. So if you were moving from the lowest 7% of funds relative to the average investor experience as measured by asset weighted expense ratio of the entire mutual fund ETF industry, then that difference was about 30 basis points. So we're saying advisors could add 0 to 30 basis points. So 0 if they're going to hold the weighted average expense ratio, and then for every amount below that, right, that's additional value. And the great part about that one is that it applies every year and it compounds through time. So it's not just a one time; it's through time.
So let me push back on that again. Forgive me. I'm not being. I don't wish to be combative, but I just want to say that there are different ways of looking at things. So wouldn't it be equally fair to say that if you fail to recommend low cost investments, you're actually subtracting value, which is to say, if you're an advisor who uses high cost products, then not only, even if you're doing behavioral coaching, if you're doing behavioral coaching and adding the, let's call it 1.5%, if you're also using products like over 2%, what you on one side, you might inadvertently be subtracting on the other. But it's funny because it's depicted as adding value by using the low cost products, but not as subtracting value as a result of using high cost products. But it's different ways of saying the same thing.
Agree, but I think the important thing is if an advisor is picking a high cost product, the hope would be that they believe the alpha that would be derived from that product would offset the additional cost, right? So that's kind of a judgment call. So I agree entirely. It's really up to each advisor of if you're charging 2% for something, you would hope that, for a product, you would hope that you expect that would be providing at least 2.5, 3, 4, or more, right?
Right. Okay. All right. Let's see if we can wrap up where we're going with this here. Is there anything else that you want to say with regard to asset location or the drawdown locations in terms of value being added? Because again, I've seen research that, depending on which tax bracket you're in and depending on the expected returns of different asset classes, equities are likely to outperform income, but they're also taxed at a preferential rate. But, when you take into account tax deferred compounding in government plans, the benefits might not be as great as you otherwise thought. I don't know if you've done a sensitivity or if the research is just a very broad, big picture. This is on a balance of probabilities, taking into account a wide range of possible outcomes. This is our best guess without drilling down into a sensitivity.
So I would not say that I guess we've done sensitivities on time horizon, on different asset allocations. So I guess at the highest level, right, when you think about what assets you buy and which buckets of money makes a difference, right? So you're going to want to put tax efficient assets in your taxable account, right? In your tax deferred account, probably the lowest growing. So we would say something like taxable bonds, right? Lower growing assets, because all of that's getting taxed at ordinary income tax rates on the way out, right? So if you have an allocation of bonds, that's probably where you're going to put it. And then Roth, obviously the highest and least tax efficient or tax-free accounts, right? So situating assets that way adds value. I don't know that there's sensitivity around that as much as it's just the after-tax returns on those assets when you put them in tax-deferred, tax-free accounts is preferential. And then any indexing that you want the taxable account, right, will kind of maximize the returns. Withdrawal order can be a little more tricky, right? So it's basically a more holistic plan of how you think about drawing down those accounts based on, like you said, tax brackets, based on in the US, Social Security claiming, and how that will be taxed differently in the future, required minimum distributions. There's a lot of factors that go into it. So here we just use the rule of thumb, but in the paper, we really leave a broad range of saying this is not all the value we think advisors can provide, right? There's many other ways they can add value. We pick the ones that are most applicable to most people, right? And we kept it at a high level, more so that people could kind of do the personal one-on-one, right? We're just trying to say at the highest level, doing asset location or not doing asset location makes a difference. Paying attention to where you're spending in retirement makes a difference. And the value could more than offset the fees.
Perfect. You've got so much information. We're going to have to come back and do a part 2 in a few minutes. Before we finish off though, Colleen, I always like to finish off the podcast with 2 things. The first is something that I call That's Bullshift. And that's where I invite my guests to point out something that they think the financial services industry could be done a bit differently, and differently means better. What do you think the financial services industry could improve?
So, I guess one of the most important things is almost how we started out is, right, a lot of advisors are still spending a majority of their time on portfolio construction and defining and, kind of saying that their value proposition is solely based on investment management. And we're not saying that investment management isn't important, but right, we really do encourage advisors. So the shift to me is really redefine your value proposition, right? From security selection, right? The market has become, investments are almost commoditized at this point. So it's really kind of going forward, to be successful going forward, spend your time really focusing on financial planning, behavioral coaching, where we think you can add, more significant and reliable value. So it's really kind of like, as an industry, stock selection and kind of, focusing on portfolio construction, really should really shift more towards holistic financial planning and really focus on, are your clients meeting their goals or not?
Right. Okay. So then let's move that on to Shift Happens. If it was up to you, how would you encourage the financial services industry shift toward more holistic financial planning and things that add value to the clients that we serve?
Yeah, so I don't even know if you would need me to make this happen. Clients expect more now, right? The truth is, clients are expecting more, and they're demanding more, or they'll go to somebody else who's going to do it. What I could suggest that advisors do is not always lead with the statement, right? If the conversation is, here's your statement, and it's really hard not to focus on investment performance as the most important thing when the quarterly or semi-annual or annual conversation is, this is a statement, let's look how your portfolio did. And I would say instead, lead with, these were the goals that we set, and this is how we're tracking towards your goals. And then, of course, you're going to have to talk about performance at some point, but lead with how your client's tracking toward their goals, lead with building trust and relationships. And the performance is really just, part of the whole package that you're delivering.
Perfect. Thank you so much, Colleen. It's been a real pleasure speaking with you today.
Same. So really enjoyed the conversation. Thank you.
John DeGuy is a portfolio manager with Design Securities in Toronto. He is the author of both Bullshift, How Optimism Bias Threatens Your Finances, and Stand Up to the Financial Services Industry, Protecting Yourself from Well-Intended but Oblivious Advisors. The books are available online and in bookstores everywhere. The opinions expressed on Bullshift and Shift Happens should not be construed as investment advice. You can reach John at jdeguy@designsecurities.ca or at 647-STAND-UP. That's 647-782-6387.